Hi, this is Rob Booker, and I'm glad you've joined us today for a special webinar at FX Street on the National Futures Association and some new rules. I'm joined by Corbin Layton, who works together with me. Corbin, if you don't mind, I'm going to turn off my microphone and allow you to introduce yourself briefly.
Hello, folks. Corbin Layton here. I work with Rob. I'm fortunate enough to kind of be his patsy, his protege, his workhorse. I used to work for a major broker. I met Rob through the course of that. I've been trading currency for about 2 years now, and now I work with Rob, and we educate people, and we trade, and we manage money together, and we have a great time. So that's me in a nutshell. And I'm excited to be here. I'm excited to talk to you guys about this. Go ahead, Rob.
All right, everyone. It's important for you to know from the very beginning that we are an organization. We trade our own money, and we do live training either in group settings or on a very personal one-to-one basis in person. We are not regulators. We are not critics or supporters of the sinfully to identify some of the how the future holds with regards to regulations. Is application of some of the things that it's been doing. In fact, I think there's been a lot of criticism of the National Futures Association. You don't have to agree with them to perhaps understand their method of reasoning. So without further explanation, I want to preface the webinar today by describing we are going to focus primarily on the new National Futures Association Rule, Compliance Rule 2-43. And I think it's important for those of you that trade in the United States to understand where you find this information. You can simply type into Google Compliance Rule 2-43. You can type in NFA Compliance Rule. And I'm going to share my screen in a moment here. You can actually type in Compliance Rule 2.43. And what you come up with is an actual Compliance Rule 243, and you'll get tons of results. Which include results from forums where people have discussed the rules. But at the very top, you'll actually get information from the National Futures Association on new Compliance Rule 2-43. I've pulled that up just like on a cooking show where they've already pulled something up or cooked it so you can see what it looks like. I've already pulled up this regulation, and notice that I'd like to go through this rule and take about 30 seconds. All right. There we go, folks. Here we go. Ed, we're not going to address your question right now. We're going to save that for later. Number one, the effective date for the regulation is included in the first paragraph here. But I want to read first about offsetting transactions. New Compliance Rule 243B requires an FDM, a Forex dealer member, to offset positions in a customer account on a first-in, first-out basis. This is otherwise referred to as FIFO, F-I-F-O, first-in, first-out, thereby prohibiting a trading practice commonly referred to as hedging. A customer may, however, direct the Forex dealer member to offset same-size transactions, even if there are older transactions of a different size. Rule 2-43B is effective for any positions established after May 15th, and offsetting positions that were established prior to that date do not have to be liquidated, but once either position is closed, it may not be reestablished as a hedge. Let me give you some history about hedging with the National Futures Association, and then discuss with you why in the world they did this, and then practically speaking what it means. Number one, the history on this is that for quite some time last fall, the National Futures Association solicited commentary from Forex dealer members and others about this rule, meaning long before this rule was put out, they solicited and asked for commentary on this rule from Forex dealer members in the United States. And it was very clear from the very beginning and for a long time that the National Futures Association did not like hedging. Now, a lot of people were upset with the National Futures Association for restricting their freedom and restricting their right to execute trades in the same direction, in different directions at the same time in the same account. And Corbin will remember this. There was a lot of discussion at Interbank FX when I was there as the chief market strategist and Corbin was there working together with me. There was a lot of discussion internally at Interbank FX because customers were very upset about the possibility that they would not be allowed to hedge their transactions any longer. And for a small group of people, hedging was a profitable practice and they were able to do it profitably. But let me describe something to you that may provide a little bit of history on the subject and may help to explain a little bit about where the NFA was coming from. During my time at Interbank FX as the chief market strategist, I had access to research every customer position in the database that had ever been taken that was open or that had been closed. And I never found a consistently profitable trader who used hedging as a strategy, ever. Now, I found a lot of customers who were locked into losses and had been locked into a loss for a long time. But I never saw one consistently profitable trader who executed or did hedging as a strategy. Now, Corbin, I'm going to ask you a question. Corbin, does that mean that hedging never works? And does that mean, what does that mean to you, Corbin, in particular? Okay, we'll have Corbin turn off the sound, and I'll turn mine back on. And we're going to try that again in just a moment. However, I want to follow up, and I'll answer the question for Corbin. It's unfortunate that something that people loved as much as they loved hedging was restricted. It's unfortunate that something that traders wanted to do was restricted. However, during the time that I was at Interbank FX, I wrote a newsletter that went out to the client base. And I basically said, I can't find any traders of 30,000 traders and $50 to $70 billion in monthly volume, tens of thousands of trades per month, thousands and thousands of trades. I could not find one consistently profitable trader who employed hedging as a strategy. The reason that this rule exists is that the National Futures Association was worried that customers who were hedging were losing savage amounts of money, that they were sticking inside of hedged positions for huge long periods of time. Now, let me say something else before anybody becomes upset. I think that if you want to hedge your transactions, I think that you ought to be able to hedge your transactions. If that loses you money, I think you ought to just go ahead and be able to burn your money. I think you ought to be able to lose money if that's the decision that you want to make. That ought to be something that you decide for yourself. However, let me say something. There were brokers and there were introducing brokers. There were introducing brokers who were telling people that hedging was safe and that hedging helped you avoid a loss, and who were dishonestly managing people's money and locking themselves into a hedge, but then still taking management fees out of the account. Now, Harley, we're not talking about stops, and we're not talking about closing out positions just yet, but we're talking first about the offsetting transactions. We all sign disclaimers when opening up an account, and those disclaimers refer to the risks that we are taking when we sign up for an account. And the National Futures Association decided that those disclaimers were not substantial enough, and that money managers and some introducing brokers were dishonestly encouraging the practice of hedging. And I'm going to tell you what I think here is that the National Futures Association was operating from a position of wanting to protect U.S. retail customers from losing money. I think their intentions were good, and I think their intentions are very easy to understand. They offered plenty of time for comment. They offered plenty of time for people to write in. I wrote a very long response that said that there ought to be education regarding the dangers of hedging, but that traders should be offered every tool at their disposal if they want to use it. Tom says more nanny state crap. And let me say, Tom, I absolutely agree that if a trader decides that he wants to implement a certain type of trading, he ought to be given the right to do it. And he ought to be given honest information regarding what the dangers of it are. And the problem that happened was traders were simply not being well educated. They were not, no matter what anybody thinks, they were not well educated about the risks. And in fact, what I'm saying is they were told by some introducing brokers that it was safe to hedge and that they should do it. And that was the problem. Ed, okay, Ed. Let me teach you a lesson, Ed, about this. During the course of the Bush presidency, there were plenty of new regulations that were released about trading and about the financial markets that drove tons of business offshore to the London Exchange. So there just really isn't any place for you to say that the NFA crap is typical Obama policy, especially, Ed, since something that you might not realize, all of this rulemaking began under the Republican administration. So the Republicans and the Democrats don't have anything to do with this. And that has got to be one of the most ridiculously stupid comments I've read in my entire life. And now I'm going to boot you out of the webinar. No, I'm not going to boot you out of the webinar. But Ed, please leave that out for a minute and realize that Barack Obama doesn't give a shit about your Forex trading. He's not involved with that. The National Futures Association is not a Republican administration or a Democratic one. The people who are there have been there through the Bush administration and are still there through the Obama administration, the people who make the rules. The guy that runs the whole thing, maybe that'll change. But the people who were making these rules, Ed, they were appointed and they were hired, and they were not hired based on their politics. They were hired based on the fact that they like to regulate. Now, if you don't like regulation, it doesn't matter which administration is in there. So leave that out. That has nothing to do with it. Corbin feels uncomfortable. Okay. Harley says true hedging was never an issue for him. However, he did appreciate closing out the orders in the order that he chose. That is absolutely right. Okay. Here we go. Let's talk for a minute then about hedging. Hedging is over unless you move your account overseas, but I'll have more to say about moving your account overseas in just a little while. The second part of this rule, the offsetting transaction rule, required that you first in, first out. I'm going to unshare this. I'm going to turn off my microphone, and we'll give Corbin a chance to speak, if Corbin can hear me.
Thing is moving around. There we go. All right, so Rob, I'm sorry. I was so preoccupied with making sure my microphone worked. Rob, I'm going to turn my microphone off one more time. I'm going to have you just kind of repeat the question for me, and I'll be happy to respond. I just wanted to make sure that my microphone works. So, Rob, I'm going to turn my mic off now. Go ahead and ask me the question again, and I'll tackle it. I'll sink my teeth into it.
Thanks, Corbin. Alex, both Corbin and I did leave Interbank FX. We no longer work there. I was the chief market strategist from September to December of 2008, but I simply enjoy working on my own much more than working in a large corporation. Good people. Todd Crosland of Interbank FX was a friend, and I appreciated the time that I had there. So does Corbin. Corbin, what I wanted to ask you again is, do you feel that there is any malicious political reason behind the restriction on hedging? Or do you agree with me that the National Futures Association is simply a regulatory body that basically spends their full time dreaming up new regulations and so forth?
No, there absolutely is no malicious intent. It wasn't that long ago that Forex was made available to the retail trader, and in that time there's been some terrible things and a lot of bad people who have come in and done a lot of bad things to a lot of good people. I think, Rob, that we need to make it clear that we have nothing but respect for the NFA. We adhere to what they say. Some of our dearest friends on the earth are former employees of the NFA who now work in the compliance department of Interbank FX. So no, there's no malicious intent. I think the intentions are good. I just think the policy maybe is a bit askew. And I think that's what needs to be looked at, and that's what needs to be discussed. But certainly there's no sort of conspiracy, no sort of money grabbing on the part of the NFA. It's just them. Their intentions are definitely good. The ultimate sort of goals of the NFA are to help the trader, and that's the bottom line. And that, I think, it's just a policy that needs to be looked at. Go ahead, Rob.
Here you go, Ed. Harley, I'm going to answer your question in a moment. And first I'm going to address Ed. Ed, there is just simply no room here to really give a crap about your particular views about Barack Obama or George Bush. And get your facts right. The desire for the IRS to prosecute UBS and look into those accounts started under the Bush administration. So why don't you go to Texas, and why don't you track down George Bush, and why don't you express to him your concerns? Because we're here in the webinar actually about the National Futures Association, not about Barack Obama or George Bush. So maybe you're in the wrong webinar. Harley, since you asked an intelligent question, I'm going to answer that one next. The NFA does want to model Forex like futures, and that is absolutely, positively what it seems like is the case. It seems like that has been the case. It seems like that is where they're going, and that is a perfect entry in the next discussion. I want to answer Harry's question about the big players still trading as they want, and we don't talk about politics here, and we just don't really care about that. It's not important. We're talking about regulation. Now, you might disagree with the regulations, and you might disagree that the regulations are good or bad. But we're not going to talk about whether they were motivated by people who are evil. In every instance where I've met a person from the National Futures Association, they are trying very hard to protect people. And when we were inside a broker at Interbank FX, it is unbelievable the types of horrible things that introducing brokers or bad money managers will do to Forex traders. Horrible things, millions of dollars. And the National Futures Association does not always make perfect decisions, but they usually make their decisions based on the fact that they are trying to stop some certain things from happening which have lost people a lot of money. And sometimes by doing that, the NFA does become very oppressive. It is the case. That is true. And then a lot of regulations come out, and that's why some people are moving their accounts to other places. Let's talk about FIFO for a moment. Let's assume that you buy the euro dollar, position number 1 at 1.4500. Thank you, Harry. It's good to hear that. Position number 2, 1.4490. Position number 3 at 1.4480. Position number 4 at 1.4460. And then let's say that the euro dollar, after falling all that way and after you've bought all those positions, that the euro dollar goes up to 44.70. And you want to take profit on position number 4 because position number 4 is profitable, even though positions number 1 through 3 are unprofitable. And you want to realize 10 pips of profit to help offset the problem that you've got yourself into. Well, you know what? You cannot do this anymore. This is over. This is done with. They do not allow you to do this anymore. You are not allowed to close position number 4 first. The National Futures Association, as part of the FIFO rule, has removed the possibility of closing position number 4, which is in profit, before you close number 1, 2, and 3. Now, there may be some of you out there that think that this is the dumbest rule of all time. You may think that this is the most stupid regulation that you have ever seen in your entire life. This is, incidentally, how the futures market works. In fact, if you trade with GFT or other brokers that have averaged the positions, you were always kind of in a situation where you had to do this. But if you traded with FXCM in the U.S. or Interbank FX in the U.S. or FX Solutions or other brokers, you were actually able to scale in and out of positions, and you were able to take profit on some profitable positions while leaving some of the unprofitable positions open. And you were able to pay for your unprofitable positions by closing out profitable positions. You are not supposed to be able to do this anymore in the U.S., period. You're not supposed to be able to do this anymore. Now, some brokers in the United States have written you and said that they have a workaround for that they have some method that they're going to allow you to still do this, and they're going to allow you to do it anyway. I honestly don't understand that, and I don't understand anything about those workarounds. I don't understand them. I don't use those workarounds. I don't know about those workarounds, and I cannot comment on a, quote, workaround around a regulation. I don't know why anybody would want to circumvent a regulation. And I don't think any U.S. broker wants to circumvent a regulation. However, in the futures market, what happens if you buy at 1.45, 1.4490, 1.4480, and 1.4460, in the futures market, your position will be averaged so that you have one big position and it's averaged at the price. That's how Global Futures and Forex, GFT, handles the trades, and that's why they haven't been affected by this. But most U.S. Forex dealers have been affected by this. I, personally, take multiple trades each time I trade a currency pair, and I like to be able to close some of the profitable trades before I close the unprofitable one. And so, for a lot of people, the only answer to resolving this issue has been to close their U.S. account and reopen their account with a Forex dealer somewhere outside the United States of America. And I don't disagree with that. If you do not like this rule, and I don't like this rule, then the only solution is to move your account, unless your U.S.-based Forex dealer has implemented a workaround that you think works well. I'm going to ask Corbin if he has any comments on this subject.
Over the remainder of your time to the kind gentleman from Salt Lake City here. RD, there are always going to be quote unquote workarounds, like Rob said. But in reality, it's something that Rob touched on at the beginning of the webinar, is that we want to be able to trade the way that we want to trade. The first in, first out rule was detrimental to a particular strategy that we trade, and we trade well. And so the first in, first out rule has been a detriment. It's been a detriment to us. But it makes sense logically, because in the past there were a lot of money managers, there were a lot of IBs who would hide their losses because they had so many stacked positions. And so the logic of the FIFO rule, logically, it makes sense. Practically, not so much. And I think that's where the issue lies, and I think that's where people are upset, because logically it does make sense. Logically, you can see how it theoretically could protect a trader, but in reality, it does kind of hurt, and it doesn't make a lot of sense, practically speaking. Go ahead, Rob.
I'm going to now move on to the next section of the new rule that I think is really actually quite important and very interesting. One rule that the National Futures Association issued that you may think differently about, that you may think actually helped you a great deal, is the price adjustment rule. For orders executed after June 12, 2009, Rule 2-43A will prohibit a Forex dealer member from adjusting executed customer orders with two exceptions. This means they cannot adjust the orders. They can't go in and change your trade. It means there's no shenanigans, no going in there and fiddling around with your trade. The first exception is where the adjustment is done to settle a customer complaint in favor of the customer. Do any of you remember times in forums where you would read about a dealer coming back after a trade was closed and saying it didn't really trade at that price and that they would adjust your trade against you? Well, that's over. That is over. The second exception is where a Forex dealer member exclusively operates a straight-through processing model and the liquidity provider with which it entered into the automatic offsetting position changes the price of an executed order with a Forex dealer member. Let's say that you trade with Booker Forex, and we are a straight-through processing model, and that we take your trade and then we automatically straight through offset your position with a bank. And then that bank comes back to me and changes the price to me. Then I, within 15 minutes of you taking the trade, need to alert you of that price change by the bank. And then we can adjust your trade, which means it's practically never going to happen because that doesn't happen very often. They must give you notice if they're a straight-through processor, the 15 minutes of the customer order being executed. It must state in the notice that the FDM intends to cancel or adjust the order and must include documentation of the price adjustment from the liquidity provider. This means it's not going to happen to you. The FDM must either cancel or adjust all customer orders executed during the same time period and in the same currency pair or option, regardless of whether they were buy or sell orders. This means that they can't just do your order. If they're going to adjust them, they have to adjust all of them. All cancellations or adjustments of executed customer orders must be reviewed and approved by a listed principal. This means if you trade during the news, I think you may get better execution from your U.S. dealer than you may have gotten in the past. Let's go over to a question and answer section from the National Futures Association website. It'll just take me a moment to pull that up. And there's a section of the National Futures Association website that actually does answer some questions about it. Does this mean, says question 1, that a Forex dealer member can't make favorable adjustment if the customer does not complain? Well, it depends on the circumstances. The intent of the provision is to ensure that Forex dealer members can settle customer complaints before or after they end up in arbitration, meaning they want to reduce the complaints that lead to court dates and arbitration. It's not meant to prohibit Forex dealer members from adjusting prices based on a glitch in the platform. Number 2, a Forex dealer member operates several trading platforms. 2 provide exclusively straight-through processing, but 1 does not. Can the Forex dealer member make section adjustments for trades placed on the 2 platforms that provide straight-through processing? No. For price adjustments made under section blah, 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 the rule requires written notification. If the liquidity provider informs an FDM of the price change 20 minutes after the order, can the FDM still make the adjustment? No. It has to be within 15 minutes. It's a narrow window. Harry, it's absolutely true that the NFA wants to regulate Forex. That's true. They don't want to regulate Forex because they hate you. They want to regulate Forex because they're regulators. That's what regulators do. They regulate things. All right. Let me read you some related questions, and this is actually the most interesting portion of the webinar, I think. And Corbin, maybe after I read through this, you can actually comment on some of it as well. Related issues. may a Forex dealer member transfer foreign customers to a foreign entity that allows customers to carry offsetting positions in a single account? What this asks is, may a Forex dealer member transfer foreign customers outside the U.S. to a foreign entity that allows the customers to hedge? The NFA says yes. And I think that's just funny, don't you? That the NFA is telling them that they are able to transfer foreign customers. It's pretty funny. If done as a bulk transfer, however, the interpretive notice requires that the foreign entity must be an authorized counterparty, blah, blah, blah. The answer is yes, if you live outside the country. May a Forex dealer member transfer U.S. customers to a foreign entity that allows customers to carry hedging positions? Listen to this. Only if the transactions are not off-exchange futures contracts or options. The legal status of spot Forex transactions that are continually rolled over and almost always closed through offset rather than delivery is currently unsettled, meaning the issue is unsettled about whether it's legal to move U.S. customers to a foreign entity that allows hedging. It's currently unsettled. Therefore, if a Forex dealer member chooses to transfer U.S. customers to a foreign entity so they can continue hedging, it does so at its own risk. In any event, a bulk transfer can only be made to a counterparty authorized under the CEA. What makes this kind of thing makes me wonder why the NFA, frankly, and I mean this with the most amount of respect, why the NFA didn't spend its time regulating how client funds are held rather than worrying about whether a Forex dealer is going to move people offshore or not. Why doesn't the NFA get tougher about how the client money is held and not worry so much about this? I don't know the answer to that, but they're regulators and they're going to regulate and they're going to do this. Listen to this. If the transactions are not done as futures or options, does that mean that none of the NFA's rules apply? Listen to this. A Forex dealer member that misrepresents the characteristics of hedging by touting the benefits of hedging, or misrepresents the characteristics or the NFA's purpose in banning hedging, or that implies that transferring U.S. customers offshore will make the transactions legal, violates Sections CR 2-36. And this applies to introducing brokers and account managers and people that work on behalf of the firm. Let me make it extraordinarily clear. If your broker moved you from a U.S. account to an offshore account to allow you to hedge, your broker was not telling you that it was legal and was not criticizing the NFA and was not misrepresenting the National Futures Association. Just make that clear. Corbin, why don't I let you speak for a moment and share with us your thoughts?
Is it like me telling my 8-year-old daughter not to climb the tree because I'm afraid she's going to fall and break her arm, and then say, you know what? It's okay. I'm not going to touch it. It is iffy, and there's a lot of room. There's a lot of ambiguity. There's a lot of room for interpretation there. I think what strikes me the most is that we're all kind of going through this process together. We're all kind of learning, and I don't want to say making the rules up as we go, but it is such a relatively new sort of field. It is sort of a new asset class, this whole retail Forex. So as we're going along and we're learning, I find it comical that these things are still undecided and still ambiguous. But on the same token, it does leave us open for options, and it does give us options as to what we want to do with our money, and give us option to trade as we want to trade. And so that's really what I like about it. Thanks, Rob. That was a nice compliment. I did go to college. So if anything, that's what that strikes me as, is that as we are kind of progressing through this mire, we're doing it together, we're learning together, and best of all, it leaves options open to allow us to trade as we want to trade, which at the end of the day is what all of us really want.
I want to make it clear that we may disagree with some of the regulations, but as an individual and as a company that I own, we support as the regulations come out. You understand that you obey the law. That if the regulations are issued, you obey the law, and that's the way it is. And if you don't like the regulations, then maybe you do open an account somewhere else. Maybe that works. I can't say that that's legal. I can't say I can't make an opinion about that. But I can tell you that people are moving their accounts because they want to trade in the way that they've always been trading. And I don't know where the balance is here. And I wish that the NFA would perhaps do a better job of promoting the reasons for the regulations and share more information with customers. What I'd like to do to finish up some of the time that we have together today is I'd like to tell you more about what seems like it's coming down next from the National Futures Association. Okay, number one, the new possible. The NFA did move very fast. You're right. They didn't move too fast, Harley, though. They asked for a lot of commentary and discussion before these regulations were issued. Possible new regulations include a restriction on leverage from U.S. Forex dealers. It is possible that by the end of the year, by the end of 2009, that U.S. Forex dealers will not be allowed to offer leverage greater than 100 to 1 on some currency pairs, like the euro, and not greater than 25 to 1 on some currency pairs, like the pound yen, euro yen, pound Swiss, euro Swiss, and some other currency pairs. That is likely to happen, folks. And like it or not, the leverage offered in Forex is unbelievable compared to the leverage offered in other financial instruments. It's unbelievable. Number two, a possible new regulation will come out within the next 12 months, I believe, about how your money is held. Right now, in the futures market, if you trade futures like corn, beans, gold, and whatnot on the futures market, your money is insured at multiple levels. And if your futures broker, like Interactive Brokers, declares bankruptcy, the money in your personal account at Interactive Brokers or anywhere else like that is protected from the bankruptcy proceedings and cannot be used or attached in any of those bankruptcy proceedings. It would be great if the NFA started to treat the holding of money in Forex more like they treat it in futures. They're going to regulate things. Why don't they just regulate it all the way to really protect us? It's possible that in Japan, leverage will even decrease even further than that. Everyone, that's all I have for the regulations webinar. On behalf of Corbin Layton, I'm Rob Booker. You can find us at robbooker.com. You can ask us questions about the training that we do or follow-up questions about the regulations at rob@robbooker.com. You can email us anytime at rob@robbooker.com. You can also find us at piptopia.com, and you can also find us at robbooker.com/postcards, where we run a free ad-supported trade-related service that you're welcome to participate in it. And we thank you for your time today. Thanks, everybody, for being here. On behalf of Corbin Layton, I'm Rob Booker. Have a nice day.